Imagine collecting rent from hundreds of buildings without fixing a single leaky faucet. That's the promise behind REIT ETFs, Real Estate Investment Trust Exchange-Traded Funds. In the next few minutes, I'll show you how they work, why they rise and fall, and a simple checklist to pick one with confidence. Stick around to the end for that quick checklist you can screenshot and use before you invest. First, what are REIT ETFs in plain English? Think of them as baskets filled with companies that own or finance real estate. Instead of buying one landlord, you buy a whole neighborhood of landlords. Warehouses, apartments, hotels, data centers, cell towers, even medical offices. Most REIT ETFs are built to mirror a published index, like following a map. That means they're usually passively managed. The fund holds what the index says, adjusting as the index changes. One important quirk, many of these indexes are top-heavy, like a music playlist dominated by a few headliners. A handful of the biggest REITs can drive a lot of your returns, for better or worse. So how do they make money for you? REITs are designed to pay out most of their profits as dividends. Picture a steady stream of rent checks flowing from properties to the REIT and from the REIT to you through the ETF. That income focus is a big draw, especially if you want cash flow without dealing with tenants or toilets. But remember, yields move, dividends aren't guaranteed, and prices can swing like regular stocks. REITs live in the stock market, so they can be emotional in the short term. Let's talk about what moves them. Interest rates matter a lot. Real estate is sensitive to borrowing costs. When rates rise quickly, investors often demand higher yields from income assets, and REIT prices can get knocked down. On the flip side, when rate pressures ease, REITs can rebound as financing becomes cheaper and investors rediscover income. Another driver is the health of each property type. Industrial warehouses might soar on e-commerce demand, while offices can struggle if vacancy stays high. A REIT ETF spreads exposure, but your mix still depends on what the index allows in. Some include mortgage REITs, which don't own buildings but hold real estate debt. Higher yield, higher risk. If you don't want that, read the prospectus and index methodology before you buy. Costs matter too. Because many REIT ETFs track indexes, fees are often low, but not always. A small difference in the expense ratio compounds over years, like a slow leak in a bucket. Liquidity is another subtle cost. Funds with thin trading volume can have wider bid-ask spreads. If you're putting in a sizable order, consider using limit orders to avoid paying more than you intended. Taxes deserve a quick note. Dividends from REITs can be taxed differently than regular stock dividends, and cross-border investors may face withholding taxes. If you're investing through a retirement account, some of those headaches may be reduced, but always check your local rules. The point isn't to memorize tax code, it's to make sure your income stream doesn't surprise you at tax time. How should you think about risk? Picture three dials: rate sensitivity, concentration, and sector tilt. Rate sensitivity is how much your ETF reacts when borrowing costs change. Concentration is how top-heavy it is, how much the top 10 holdings dominate. Sector tilt is the property mix. More data centers and cell towers can make the ETF behave differently than one heavy in malls and offices. You don't need a PhD to gauge these, just look at the top holdings, sector breakdown, and past drawdowns during rate spikes. Let's make this practical with a quick example. Suppose you want income you can live with, and you believe logistics and digital infrastructure have durable demand. You might start with a broad REIT ETF for core exposure, then add a smaller satellite ETF focused on industrial or data center REITs. Now your core holds the neighborhood, and your satellite targets the streets you like best. If rates surge and prices dip, you add gradually, dollar cost averaging, so volatility becomes an ally instead of an enemy. As promised, here's your 5-point pre-investing checklist. 1. Define your goal: steady income, total return, or a blend. Your goal decides your risk tolerance and holding period. 2. Read the index fact sheet and prospectus. Confirm whether mortgage REITs are included, check the top 10 weights, and skim the rules for additions and deletions. 3. Check costs and liquidity. Compare expense ratios across similar funds, and glance at average daily volume and bid-ask spreads. 4. Inspect the income profile. Look at the 12-month distribution history and whether payouts have been stable or jumpy. Remember, consistency often beats chasing the highest headline yield. 5. Stress test mentally. How did this fund behave when rates jumped or when real estate headlines turned ugly? If a 20 to 30% drawdown would shake you out, size your position so you can sleep at night. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. In short, a REIT ETF can hand you the keys to an entire skyline without ever swinging a hammer. You get diversification, potential income, and simplicity. But the smartest investors treat them like a business. Know what you own, know what it costs, and know how it might behave when the weather changes. If you found this helpful, replay the checklist at the end, jot down the 5 steps, and use them the next time you screen an ETF. Your future self, collecting those rent checks without the repairs, will thank you.